How do I know when to hold them and when to fold them in real estate? I just had a tenant move out of Arbor Street in Kalispell, Montana. This is a house that I bought sub 2 with 2.5% interest a couple of years ago. One of my students, Landon Moore, brought this deal to me. He made 10 grand saving a seller from foreclosure. Praise God, love that. I love the fact that we can do that. But now my tenant, who I've been cash flowing on for the last couple of years, has finally moved out. Most of the time, real estate investors, you guys think all we do is just keep putting new tenants in, but we're deciding to sell this house. And by the end of this video today, I want you to understand when real estate investors sell versus when they hold the property and continually refinance. We're gonna go over to the whiteboard. We're gonna break down all the math so you can understand by the end of this video how you can make these decisions too. So at the end of the day, this comes down to numbers and an equation, which we'll break down on the whiteboard here in a couple of minutes. But there's other things that you got to take into consideration. Number one is, what is the timing of other projects that you are buying? If I have a big RV park, for example, that I'm in the process of buying, and my close of escrow is 3 or 4 months later, I might look at my portfolio of single family houses and say, what property is currently going to have a vacancy in the next 30 days? Why is that important? Well, because if I have a vacancy on a property like Arbor, and there's equity in that property, I know tenant's gonna move out. That gives me the ability to clean it up, mow the lawn, put it on the market, and sell that thing so that I can do a 1031 exchange. Think about how cool this is. I bought this house on Arbor with no money out of my pocket, nothing, okay? It's cash flowed me. I feel really embarrassed telling you this because this is like the cheat code. You ready for the cheat code? Okay. You know real estate investors don't pay taxes, right? Okay. The way we don't pay taxes is something called depreciation. Okay, it's a stupid little IRS word that basically says we're gonna reward you when you buy real estate. And we're gonna reward you by not charging you interest, or I'm sorry, not charging you taxes on your income because you bought houses and you put it into the marketplace and you made affordable housing available. So they give us this reward, a little tax benefit. So even if I didn't cash flow on that property at all, it saved me probably $80,000 in taxes in year 1 of buying it. So I'm no money out of my pocket. I have no credit, no bank involved whatsoever, but because I own that property, I got $80,000 taken off of my taxes in year 1. That's insane. That's a lot of money. Now, what's great is that property will go up in value over a couple of years. So that property's gone up in value probably about 100 grand since I've owned it. Now, I look at RV parks I'm buying and I go, okay, well, I just made 100 grand in equity. If I sell the house, Trevon, and I have $100,000 in equity and I take that $100,000 and put it in my pocket, what happens when I make that 100 grand? The IRS comes along and does, called capital gains. And it's gonna be in the 30 to 40% range. So even though I made 100 grand, what did I really get to take home? It was like 60. That sucks. Yeah. I don't want that. And on top of it, that tax benefit I just told you about, the IRS says, hey, you didn't own the property long enough, so we want some of that tax money back. And I then have to go, and that's called depreciation recapture. It's a stupid word that a lot of people just goes over their head, but basically the IRS says you didn't own the property long enough, and so we want some of the reward we gave you. And so out of that 100 grand I make, they take $40,000 for capital gains. Then they take some of the tax benefits back from when I bought the property, and I might walk away with $20,000 to $25,000. Okay, well, cool. $25,000, I was in the deal with no money out of my pocket. But how do I avoid those taxes? How do I avoid capital gains tax, and how do I avoid depreciation recapture? Well, there's this magical thing that allows me to take my profit from a real estate deal and roll it into another real estate deal so I don't have to pay any taxes on the 100 grand. That's called the 1031 exchange. So I can make 100 grand on this house. Again, I made 100 grand out of thin air. Like, I create money, right? It's basically printing money. These houses just print money. I make 100 grand from that house in appreciation. I get to keep my tax benefits, and I can roll that 100 grand into an RV park for maybe the down payment on an RV park I'm buying. And so sometimes it doesn't come down to the equation, although it will come down to the equation when we get on the whiteboard. But there are situations that I look at and I go, okay, I have a couple of RV parks, I have a multifamily property we're turning into Section 8 right now. I could sell these single families, take the cash, roll into that thing. And so some of it comes down to timing and what's going on in my current pipeline right now. One of the most exciting deals we have going on this year in 2025 is a motel, 102 units. You went there, right? It's the one where there's condoms all over the ground and zombies walking around. That property, Trevon, we are buying for $3 million. The seller is not requiring us to give him any down payment, any monthly payment. He is letting us take over that $3 million property, but we have to now go put $7 million into the property. So what I'll do is I'll take some money from a couple of my single family properties as part of that. I will also go to the sub 2 community and raise money from them so they can partner with me on a deal. And I'll spend $7 million turning that property into something exceptional, and then we'll turn that into a Section 8. Well, that gives me the ability, when I have a project like that, that gives me the ability to choose some of my single family houses, sell those, and roll those into a much better, higher end product. But the number one thing we're going to talk about on the whiteboard today is return on equity. There's been times where I have $300,000, $400,000, $500,000 in equity tied up in a house, and the return on equity is the equation we're going to talk about at the whiteboard right now.
Okay, before I jump into why would I sell a property when I keep telling everybody go and buy property, let's remind ourselves why we buy properties in the first place. Number one, first reason is what most people think of as cash flow, right? We want cash flow. Now, my good friend Cody Sanchez, she criticizes a lot of real estate investors. She says, oh, my real estate investors only make $400 per property. Well, if you're not doing co-living and you're not doing some other high-end cash flowing deals, I totally agree with her. The problem is we don't buy property for cash flow. Most real estate investors that are doing single family residential stuff, we buy property for another 4 or 5 reasons on top of cash flow. So cash flow is important. It's nice to have a property that's not hemorrhaging and losing money. But number two, one of the biggest reasons is appreciation, okay? The property goes up in value. Unlike a business that I have to force value into and I have to increase revenue, sales, branding, marketing, all of those things, manage employees, I can just sit on a piece of property and let it ride. Real estate appreciates. It is scientifically, mathematically proven over all of these years. It has never gone down over the long haul, right? You might have a bump like 2008 or a bump like in 2023, we had a settling in the market, but it always goes up. So appreciation, and this is one of the reasons why I don't love buying in Iowa or Ohio or some of these like flyover states. They don't appreciate as much as I like. I like Maricopa County. I like Phoenix, Arizona. I like Las Vegas. I like Atlanta, Georgia. I like North and South Carolina. I like Texas. I like places that grow in value. Number three, one of the biggest reasons why we buy real estate is so we don't pay taxes. So we call this depreciation. And of course, if you look at the big, beautiful bill that just came out, we've got a whole video coming out just on that here. Big, beautiful bill is all about making it so people like me don't pay taxes. I have not paid federal income taxes in 7 years. And the reason for that is the IRS rewards me with something called depreciation. They say, hey, Pace, if you are buying real estate, we will reward you by wiping out your active income, which is awesome. So depreciation is another reason why we buy real estate. The downfall of the depreciation is that we will have to recapture those benefits if we sell that property. More on that to come. Number four, this is one of the great parts of owning real estate is that 37% of the average American's paycheck goes towards paying rent. So that means that these tenants are paying my rent. 37% of their paycheck is going to my rent, which means mortgage pay down. So think about this. If I hold this property over the next 30 years, my tenants will pay that mortgage off 100%. All my taxes, my insurance, my management, all of those types of things will be paid for by my tenants. Dave Ramsey, you are wrong. Your tenants do pay for all of these things. They pay for your cash flow, they pay for your pay down, they pay for your taxes, your insurance, and all of those types of things, okay? Now, number five, one of the best reasons why we buy real estate is leverage, okay? I have videos about this, but leverage is beautiful because when I have equity on a property, for example, We're here on 210 Kaufman Lane in Kalispell, Montana, my personal home in the summertime. This property I bought for $1 down payment, but I have about $1 million in equity on this property. It's worth 3.7. I owe about 2.7 million. So I have $1 million in equity. I can go and raise money for other projects and use this house as collateral. That $1 million allows me to go and borrow money on other projects and make those projects happen because I have equity on this one that makes my investors safe. Leverage, okay? Now, number 6, big one, is when I pull money out. Let's say I do a refinance, I refinance a property, I don't pay taxes on refinance money because it's getting new debt. This is how the rich live. We do not go get new income, we go and borrow money against the asset, and then boom, the tenants pay down our new loan. It's kind of a beautiful thing. So refinancing, okay? Now, the other big reason is because when we get all of these benefits, and we then decide to sell, which I'll jump into in a second, we can now do a 1031 exchange and roll and compound all of our profits into the next deal. So let's talk about, okay, yeah, we buy and hold, we love all of these massive things, but why would I sell and when do I make that decision to sell? Let's talk about that next. All right, so we know why we buy property. I think we all understand that now. Let's talk about why we would sell a property. If it's making so much money, we've got all this cash flow, the tenants are paying it down, Pace, why would you ever sell a property? Why don't you refinance that money out and keep that property? Well, number one reason is return on equity. It's called ROE. Okay, so recently I sold a couple of big properties and I pulled 300 grand out of one and $400,000 out of another. Why the heck would I not just keep those properties and refinance and get that money out? I'll give you a good example. I bought a property on Maddox. I've talked about this video a couple of times on the YouTube channel. This is in Atlanta, Georgia. I bought it for $1.1 million on seller finance. Seller gave me no money down, which was kind of nice. So 0 down, and she gave me 4% interest. I owned that property from 2020 to 2024, so about 4 years, and I ended up making about $400,000 on this property over that time frame. The problem is this property really didn't cash flow a lot of money. At the time when I bought it, I turned it into an Airbnb. What happened with Atlanta, Georgia, is Atlanta, Georgia outlawed Airbnbs for people like me. People that don't want to own one piece of real estate, right? People say, oh, Pace, it's not outlawed. Atlanta did not outlaw Airbnb. Yeah, they did. They put new rules and regulations against people like me, which I had 75 Airbnbs at one point in Atlanta, Georgia. Guess how many I have now? 0. Because they want you to follow certain rules and regulations that I did not want to follow. Guess what? That's called a law change. They made it illegal the way I was doing it and the way 99% of people do it. So I decided, well, this property can't cash flow if I'm not doing Airbnb, or it cash flows very little. So I waited for the property to appreciate. I sold the property because if I had $400,000 tied up in it and it's not cash flowing me, think about this. I have $400,000 in cash. If at the end of the year I made $5,000 in cash flow, what is my return on equity? Think about it for just a second. What is my return on equity if I have $400,000 in cash tied up in this property? What's my return on equity, everybody? 1.25% on my money. Okay, so $400,000, $5,000 return, I'm getting a 1.25% interest on my money. That's not a really great return, right? Especially considering if I gave you money for your fix and flip, I could get 10 or 12% on my money. So this is a really horrible place to keep my equity. Well, Pace, this is important, Zach, camera guy, and everybody else out there, important for you to understand. If I have $400,000 in equity tied up in a property that's not currently cash flowing, and the seller gave me 4% interest on that property, I go to a bank and I do a refinance. Am I gonna get a 4% rate right now? Okay, interesting. So I'm gonna get probably closer to 7% interest. Well, Pace, I thought interest rates are like down at 6%. Yeah, for homeowners. For investors, we pay about a point, maybe a point and a half higher because it's a non-primary residence. We pay a higher percent interest rate. So if I go from 1.1 million owed at 4% interest and I'm only cash flowing $5,000 a year, now I'm gonna go to, well, now the property's worth $1.5 million. and I go refinance at 7%, you think this property is going to cash flow anymore? No. So in these situations, you make the decision, it's not a good time to cash out, refinance, and keep the property. Best thing to do is sell the property, pull the $400,000 out, and do the magical thing called 1031. 1031 allows me to take all my profits, all my tax benefits, all of these beautiful things, and roll it to the next property. So what I'll do is I'll sell all of this, and I will take this $400,000 in profit, and I will then roll it into something much larger. Good example is I will roll this into an RV park. Okay, I've got an RV park right now in Kermit, Texas that we are currently under negotiation. We have it under contract and we are waiting for close of escrow. This RV park is a $1.5 million purchase and the seller wants a down payment. So beautiful thing is the house on 78 Maddox made me $400,000 with no money out of my pocket, $0 down. I earned $400,000 over 4 years. I can take that $400,000 that I created out of thin air, welcome to creative finance, and I can roll that into the park in Kermit, Texas. This park nets every single month $26,000 per month. Nets. When I say net, I'm not talking about net operating income. That is in my pocket. I can go spend it on sushi, or heck, I could buy a new Prius every month if I wanted to. So $26,000 a month. Let's do the math here. Okay, so I'm making 78% cash on cash return from that money. That's pretty incredible. So should I keep my $400,000 tied up in Maddox at 1.25% increase, or should I roll it into a larger asset that's gonna make me a lot more money? Now the beautiful thing is, well, Pace, why did you buy this house? Why don't you just buy RV parks? Well, I bought this property for no money out of pocket. Use seller finance. You guys can go back in the archives on YouTube and you can watch me talking to Jillian, the seller, 5 years ago. And I bought the property, no money out of pocket. I negotiated a deal with Jillian, by the way, that every time I went to Atlanta, she had to buy me a steak dinner. It was a great structure, freaking loved it. And I made $400,000 out of thin freaking air. Nothing. I literally sat on that property for 4 years, did nothing. No employees to manage, nobody to worry about, no repairs. Literally it sat there. I owned it, cash flowed a little bit of money for the first couple of years, almost broke even for the last couple of years because Airbnb got outlawed. And then I decided it's time to sell. I 1031 into this new park that will give me a 78% cash on cash return. Now, of course, could I go and buy an RV park without doing all of this stuff? Yes. I could go raise capital, right? I could go find people that want to bring that $400,000 to me, or I can do a little bit of combination of both. So the biggest reason why an investor will sell a property instead of refinancing is the return on equity. So I'm getting a higher return on my equity. That's number one. Number two, if I refinance this property, it wouldn't cash flow. So now that equity is stuck in that property. And by the way, I'm trying to consolidate into one market in my single family portfolio, and that's what I'm going to be talking about next. What am I doing over the next couple of years in my portfolio? How am I changing the way that I'm investing? And then we're going to talk about trends in 2026. So the question I get now all the time is, Pace, what are you doing with your portfolio? I know you used to be a wholesaler in 2012 and you did that all the way through 2018. I know that you started buying properties and building a portfolio. What are you doing today leading into 2026? Well, the first thing I'm doing is I'm consolidating. I went out and I bought hundreds of single family properties. Most of them are regular rentals. I started buying co-living and I went into 15 different markets. I actually really wish I didn't do that, to be honest. There's nothing wrong with it. I just really wish I focused in just a couple of different markets. The problem is I launched the Sub2 community and I have 16,000 members all over the country and it's so easy to buy deals. I just started going kind of crazy in 2022, 23 and 24. And then my team's like, Pace, what are you doing? We have hundreds of properties. So right now we're consolidating and we're trying to get our single family portfolio down to 3 markets max, okay? So currently I have 18 single family homes for sale. And out of those 18 single family homes, that's a minor portion of our single family portfolio, I'm 1031ing all of that money. So if I have 18 single family rentals, they all kind of have an average of about $100,000 in equity. I'm rolling those $1.8 million in proceeds. I'm rolling all of that money into larger assets. So that goes into number 2. I am buying RV parks on seller finance. I currently own 4. I have 2 more under contract. So I'm buying about $40 million a year in RV parks. What do I love about RV parks is they're so easy to buy on creative finance. Sub 2, seller finance, lease options, does not matter. Super easy because these park owners are all retiring. And they all are mom and pop investors, meaning they've been investing and holding these parks. They live at the park and they go, hey, Tom, let's just own this park and live here and retire here. Well, I look at it a little bit differently. I don't want to own the park and ever set foot on it if I don't have to. In fact, I just bought a couple of properties in Big Spring, Texas. I've never seen them. I don't know the address, but we bought them. I'm no money out of pocket because creative finance works. And RV parks are great because all I do is rent dirt. That's all I do for a living is I rent dirt. There's very little maintenance. So no maintenance, there's no real tenants whatsoever. There's no landlord-tenant issues or disputes. So I can buy in California, I can buy in New York, I can buy in Washington, all the places that people freaking hate landlords. I can have RV parks. Most of the people coming through RV parks are recreational people, but here's what's happening. I'm starting to notice a lot of work campers, okay, at my RV parks. People that are saying, man, I can't afford to live in a single family home anymore. And so I bought a trailer, an RV, recreational vehicle, and I've been on the road with my family and looking for the best way to get paid, which is following the construction trend. So for example, we just had a big Texas flood you guys all know about. There's people that will swarm all the way over to Texas and they will go in there and do all the work. Same thing with anytime there's a hurricane or something significant happening in Florida, all of these workers go down and they live in RV parks. Rents go up. So I love that about RV parks. I'm doing the same thing with mobile home parks. And Pace, where are you finding these deals? Honestly, I'm buying all of these deals from Sub 2 students. People that I've taught how to do these deals, they bring them to me and I acquire them all on creative finance because they brought them to me on creative finance. Number 3, I am buying businesses, but I am only buying businesses that are completely AI proof. I don't believe roofing companies, I don't believe electrical companies, I don't believe plumbing companies are completely AI and robot proof. I think most of those are gonna be massively impacted. I think they're too easy to get into, and when the trucking industry completely implodes in the next 5 years, I think everybody will flood into the trades like electrical, plumbing, landscape, all of those types of things. But excavation companies require incredible investments. And so I'm buying excavation companies right now on creative finance because they're harder to get into. I want a higher barrier of entry. So excavation companies are businesses that I am buying. Number 4, last one, I am buying multifamily through my fund. Okay, so I have a fund called the Sub 2 Fund. We have a couple of properties that we buy every year, about $20 to $30 million, and we raise capital from outside investors and we partner on these deals together. Currently, we have 3 trophy assets that are shelling out about $90,000 a month to all of our investors. If you ever want to invest with me, go to invest@sub2fund.com. This is what I'm focusing on. Now, the final one, my last buy box, is fix and flips. Okay, so I kind of treat this like a hobby. I don't think fix and flip should ever be a permanent business for you in any sense of the word. People go, oh, I'm a fix and flipper. I'm like, oh, no, do not do that. Interest rates go up like they did in 2023. Most fix and flippers got annihilated. I don't want to own a business that I get annihilated in. I can't do that here. I can't do that here. I can't do that here. And I can't do that there. I don't care what the market is doing in the first 4 or 5 buy boxes. But when I'm doing a hobby such as fixing and flipping, you're gambling. You're buying a property based on temporary judgment saying, hey, in 6 months, I think the property's gonna be worth this. Okay, well, I don't control Jerome Powell. I don't control tariffs. I don't control those types of things. And so if I have a short time frame, I better be freaking right about my judgment call. So I'm only doing about 20 flips a year. And also I'm building 15 homes in Seattle. So I dabble in a bunch of things. I have multiple different teams. I have Molly runs this department. Molly and Heidi run this department. My partner Cody runs this department. My partner Josiah runs this department. And Heidi runs my hobby of fixing and flipping. So in 2026, I want to jump into the trends that are happening and where we are going and what I see happening over the next couple of years. 2026 predictions, here we go. Number one, Airbnb, people are gonna start waking up. And what I mean by that is I think Airbnb is always going to work. I love Airbnb when it does work. People like Bill Faith, I think, are crushing it. They work on super properties. Properties are incredible experiences. He's incredible, love Bill Faith, I love what he's doing. But people that are teaching that you can go into any market and do Airbnb anywhere, those guys have been going away the last couple of years because they're wrong. People that are having a hard time in the economy, people are tighter with their money, inflation's gonna start coming up. CPI inflation just went from 2.1% to 2.4%, and that's kind of scary. People are afraid of spending their money, which means they're not gonna be going to just any old Airbnb. They want experiential Airbnbs, and so most people are gonna be pushed out of Airbnb. By the way, if you're an Airbnb and you hear me tease people in Airbnb, I do like Airbnb, it's just not my strategy. I think people like Bill Faith that are going, hey, let's focus on less properties, but way better. Let's focus on maybe a little bit more boutique hotels. Let's start expanding a horizon away from just Airbnb. These guys are crushing it. Shout out to Bill Faith. Prop tech, this is a big deal. Companies like Prop.ai, cold calling companies are going away. People don't want to cold call anymore. Hard assets. This is not just gold, this is not just silver, this is also things like Bitcoin, right? And these are things like real estate. What's happening is the dollar is weakening. We're gonna go print more money. You saw that with a, what is it, big, beautiful bill that Trump just did. We're gonna go into another $4 trillion in debt over that bill. And what does that mean? That means assets like real estate are gonna go up. 4, co-living and modular homes, things that are affordable and not stupid. No offense to tiny homes, but they're not really scalable. You're not gonna see millions of tiny homes all over the country. Those are cool for smaller little communities, but not really every investor is gonna be able to do this. However, modular homes like Sola, companies like Sola that are going out and building 400 units all out of modular. Co-living, guys, I'm telling you, co-living, shared housing, pad split is taking the country over. It's one of the number one things that I'm focusing on in my single family portfolio. It will change the game and has been changing the game in affordability. Anything that's affordable is going to skyrocket. Then 5, ultra wealthy investments. What I mean by this is people that are flipping in the big ultra expensive areas like Paradise Valley, Scottsdale, Miami, those types of areas, LA. Ultra wealthy people are just making more money right now, right? The gap in the poor people and the rich people is getting bigger and bigger and bigger. The middle class is eroding. They're either going up or they're going down. Most of them are going down. And so ultra wealthy investments like the big, massive towers that people are building in Miami. How is it that so many people are making so much money in Miami, yet other places across the country are just completely getting decimated? It's because the gap is getting larger. I do not invest in ultra wealthy stuff. My friend Grant Cardone, he goes after A class or A plus class real estate investments. That's not my strategy. I don't know that I'm smart enough to go after that. Shout out to Grant, he does a great job here. Ultra wealthy investments, places where people just aren't gonna get hurt when the economy changes. For me, I'm focusing on co-living and modular homes. So these are my predictions for 2026. Prices of real estate are gonna continue to go up. Now, there's some settling in, like Austin, Texas is kind of getting hurt right now. There's so much inventory. But what's interesting is as more inventory comes up, days on market come up, the housing prices really are not coming down. And what I think is going to happen is I see Trump really putting a lot of pressure on the Fed and Jerome Powell. And I think Jerome Powell is going to step down. I don't think that he's going to rerun come March of 2026. I don't know that I would want to be in that job if I was Jerome Powell. I think that the Fed is going to lower rates 2, maybe 3 times this year. And you're going to see prices of houses go up.